Hello, welcome again to my video. My name is Si Wing Yi from the Yi Real Estate Network. Today's topic is tappable equity. Which markets have drastic decreases? All right, so thank you for attending. So without further ado, let me share my screen, and here it is. The reference website is Black Knight's July 2022 Mortgage Monitor. And the title is Against Sharpest Monthly Home Price Drop in 11 Years, Tappable Equity Backs Off in Q2 Peak. 6 of 10 most equity-rich markets declined through July 2022. So before I begin, so this website, Black Knight, is an up-and-coming organization which are in the top of the post of the real estate market. Black Knight is an award-winning software data and analytics company that drives innovation in the mortgage lending and servicing and real estate industries, as well as the capital and secondary markets. And so they have become a very big player. Okay, so I will certainly bring more information from this company so you can get informed about what's going on in the real estate market. So this article, so let me highlight some of the takeaway that I have, and then toward the end of this short video, I will give you my personal and professional experience and knowledge to determine what all my thoughts are. And of course, you guys will feel free out there to make a comment at the bottom of my video to share with me what do you think and what are your thoughts, and then I will reply with the comments as well. Anyway, so here it is. Annual home price growth shifted from deceleration. When I say deceleration, this means the appreciation has decreased, right? It's not like the skyrocketing price growth that we have seen during the past 2 years. Deceleration means more modest equity growth, so not necessarily a negative price reduction. So, all right, so annual home price growth shifted from deceleration to decline in July as the median home price fell 0.77% from June, the largest single month decline since January 2011. All right. So more than 85% of the 50 largest US markets are at least marginally off their peaks through July, with home prices down 1% in a third and more than 10 seeing prices fall by 4% or more. So we're not talking double-digit reductions. We're not talking a crash or bubble yet. So this is hopefully this is a temporary situation. Okay, if anything, more than a double-digit dip in actual home prices, then we are in for some very serious crisis. But I don't think that's going to happen because the inventory is still very low, and the demand is still pretty moderate, pretty high out there. So I don't see a market crash. But who knows? And then this article really emphasized the definition of tappable equity. You know what I mean by tappable equity? This means how, based on the loan to value, what's the value of your home versus the loan balance. If you how the lenders would do it, if someone were to do a cash out refinance of a home, for example, they need around 70 to 75% loan to value. So if a home is 500,000, multiplied by 70% LTV, loan to value, so 70% multiplied by 500K would be $400,000. That is a tappable equity. Then the $400,000 minus your loan balance. If your loan balance is 300,000, you deduct it from 400, so your tappable equity is around $100,000. All right, so that's how the calculation goes. All right, if you're not sure, please let me know. Drop a comment below my video. All right, so tappable equity. So the amount a homeowner can borrow against while keeping 20% equity. See what I mean? Stake. hit its 10 consecutive record high in quarter 2 2022 at $11.5 trillion of equity, but appears to have peaked in May of this year. So I will turn this negative paragraph into very positive. As not only the past 2 years of skyrocketing equity growth of houses, but people that own a primary home or own an investment home over the years, all these years, 11.5%, $11.5 trillion of equity. This is huge amount. Most people in the US, the biggest asset is their home equity. So on a historical basis, in my opinion, there are more home equity available in America than ever before. So for those of you that have purchased investment properties, for those of you that have purchased primary homes and hold it long term, you are in this category of very well off, very comfortable tappable equity. So just because there's a slight correction in the market, it should not impact you if you own your home for the past few years, right? So if I were you, I'll keep the house, keep the property, and ride out the storm, invest for the long term. That is the most critical. All right, let's go on with the highlights. In some markets, equity pullbacks have quickly become fairly significant, with the 5 most equity-rich West Coast markets shredding 10 to 20% of previously available tappable equity from April through July. 10 to 20% in the West Coast market. You know what I mean by West Coast market, right? Mainly in California, and some in Washington State, Seattle, and some in the Nevada and Arizona and Utah markets. That's basically the West Coast that have achieved the greatest uptick in the past 2 years of skyrocketing home prices. So it's not like, this is a high level information, right? It's not like every single market, it's not like all 400 metro in the country, it's all going down at the same time. So real estate market, there's no such thing as a nationwide real estate market. It's only a local market. So if you own houses in other part of the country, or in the Midwest, or in the South, or Southeast, and Northeast is different, right? Housing prices are different. Economic situation on each market, each city, each metro is very, very different, right? So you can't go by this high level information that are being put out by any organization, credible or not, including Black Knight, all right? So just be careful. Don't, this data I'm providing you is just one small piece of information, so you can get more educated, more informed, and not form any kind of emotional conclusion about what you read on this article or from my video presentation or from anything else. Just, just get your emotions out of it. Think rationally, think logically, go over your personal financial goals, and make your decision accordingly by using credible data, using credible information, not using overhype, clickbait type of videos you hear out there from many YouTubers out there. All right, so just be careful to take this kind of data with a grain of salt, regardless of whether this website is credible or not, including Black Knight. So just a word of warning, word of caution. All right, and the most recent data from the Black Knight Home Price Index show the deceleration in home price growth, just, like single digit appreciation we expect to see moving forward, instead of double, triple, quadruple skyrocketing price growth we have seen, especially in the past 2 years. Does that make sense? All right. So it has shifted, right? We know, everything has shifted. And in recent months, it has shifted to an actual decline. All right, actual decline. Have to be careful. Some of these words that are being put out there. Actual decline. What is the specifics? We don't have it yet. We do not have an actual decline of home prices, not just yet. Right? We need more data. we have seen price drops from sellers that are overlisted their price to begin with, right? And giving the shift, the pullback in demand, they have to lower the prices. They have to relist their prices to meet the moderate demand out there due to the interest rate rise, right? So at this point, as we move into the fourth quarter 2022, we don't jump into conclusion. The actual decline, we don't know that data yet. So next few months, we may know by looking at the trends and what have you. And my job is to provide you with credible third-party data, not only from Black Knight, but from Redfin, from Zillow.com, from Realtor.com, and Mortgage Daily, and a few other allegedly credible websites that produce this real-time information. All right, and then let me see what else. Some of the nation's most equity-rich markets have seen significant pullbacks, most notably among key West Coast metros. Look, I live in the San Francisco Bay Area for the past 30 years, so I know about the real estate cycle. See, California seems to leading the way in terms of upcycle and downcycle, strong price pullbacks from time to time over the past several decades. But that's the way it is. California is always, everybody is leading the way for better or for worse. But to me, California always will become a ideal landing spot for many, many people from the world. People want to live in California. As you and I know, the housing market is the most expensive in the country. In California, and Southern California and Northern California, in the Bay Area, and in the LA Metro, Orange County, and also San Diego. But there's no need to panic. This is just a correction. So even though Black Knight says from April to July, San Jose had lost 20% of the tappable equity, Seattle similarly 18%, and then San Diego 14%, San Francisco 14%, and Los Angeles 10%. All have seen double-digit decline since April. Let me pause for a moment. It's very, very critical. So if you don't sell your property, you'll be fine because the market will come back. If you invest for the long term, these price drops on paper will go back, to long-term growth, steady growth. If you keep your housing assets for the long-term, 10 years or more, you will always make money. So invest for the long term. Don't panic. This price drop is only on paper, right? Because people will see this tappable equity drop only if they pull the trigger to do a cash-out refinance. But if you don't need to, if you are not in a stressful situation where you don't need to do a cash-out refinance or do a HELOC, home equity line of credit, or whatever, it doesn't apply to you. This 40%, 20%, 10% on paper price drops doesn't apply to you if you sit tight, ride out the storm, ride out the market, continue to live your life, and as long as you have a good job, you feel good about your situation, invest for the long term. Don't get emotional. Don't make decisions based on these third-party websites, Black Knight or otherwise. Does it make sense? All right. So despite the other highlight I see here is despite the 128,000 rise in active listings, inventory remain at 622,000, which is 45% below the pre-pandemic levels. Okay. And Black Knight shows 3.1 months worth of inventory as of July. To me, still a seller's market, right? A balanced market is 6 months supply of inventory. We're only at 3.1 months. There's no need to panic. So when I see this 3.1 months worth of inventory, it is still a seller's market, and they still control the transaction. And most likely, all else being equal, home prices will increase ever so slightly based on demand exceeding supply, which is still the case right now, even though you've been hearing doom and gloom scenarios. Does that make sense? Okay. If the sales continue to fall at the rate they have, been in the past 4 months, and listings continue to build at their current pace, inventory would cross the 6-month threshold by December, typically the point at which the landscape shifts from sellers to a buyer's market. Now, this is an extremely strong statement, and I'm going to almost conclude this video. This statement, this last statement that I just mentioned, is such a strong statement. It's not going to happen. There's no way. The listings, the national listing has been decreasing substantially in the past couple of months. I mentioned that on my other videos. So you're not going to see 6 months inventory by the end of this year all of a sudden. It's just not going to happen, because the trend, when I produced a Redfin video recently, a few days ago, we are seeing a listing have been decreasing. Pending sales have been decreasing nationwide. So there are sellers are pulling back from putting their houses in the market. We're moving into the last quarter of 2022, where there's not that many housing transactions. So people are staying put. Sellers are locked into the 30-year mortgage at 4%, whatever, right? And they have no incentive to sell their house, which they locked in anywhere from 4% 30-year fixed rate mortgage to 2.5% 30-year fixed rate mortgage. And for them to buy, move up, sell their house, move up to buy at a 6% mortgage at a price or higher in their mortgage payment, which is double in price. They're just not going to do that. There's no incentive. There's no motivation. So the trend is the supply of inventory has been decreasing, okay, to a point where it could go as low as 2 months supply by the end of this year. That's the trend that I've been seeing from other videos that I've been producing through credible sources as Redfin and Realtor.com and a few other places, right? So this Black Knight last comment that if the listing continue to increase, which is not happening, but the listing has been decreasing nationwide. So there are less and less homes available to sell, and especially when the interest rate have risen a few days ago in the second week of September to like 6.5% interest rate. You're going to see more buyers are staying in the sideline because the affordability factor, the mortgage payment will be so much higher at 6.5% versus 3% just 5 months ago. So we have to have a pullback in buyers' demand until something good happens, until the interest rate decreases. We don't know when that's going to happen. So the sellers are not selling, the buyers are not buying. So the level of inventory could be anywhere from 2 to 3 months, in my prediction, for the duration of this year, which is only 3 months away, right? So yeah, there would not be a buyer's market. There would not be a 6 months of poly inventory anytime soon, right? That is my strong opinion based on the data I've been watching recently and based on my 30 years of investing experience, real estate, and been consulting with thousands of real estate investors to buy in different markets in the country. So I have a big high-level understanding. And again, the tappable equity, my final takeaway is that tappable equity only applies to the cyclical markets such as in California and West Coast, and not necessarily in other markets like in South and Southeast areas. The median price of homes in this location are still very, very low, $300,000 to $400,000, $500,000 median price in these affordable markets in Texas and Florida and North and South Carolina, Georgia, and Alabama. These areas of the markets of the U.S. is doing very well. Their tappable equity are pretty maintaining itself. So every market is different. Okay, don't panic just because you heard all these doom and gloom scenarios. All right, so that's all I have to say. Stay the course, learn more. I will continue to produce weekly videos about real estate investing opportunities and high-level real estate great real-time, urgent real estate news out there on many areas of the real estate market. So if you found value in this video, please click the like button to increase my YouTube channel visibility, and also subscribe to my YouTube channel. You can receive so much content that a lot of people have not produced. I also talk about real estate investing, rental properties, cash flow markets, turnkey properties in South and Southeast. Also, just go ahead and if you want to join our community of real estate investors, which are thousands of them on my network, feel free to join. You become a free member. Just all I have to do is click my website at the bottom and put your email on there, so you will receive our weekly email newsletter for great, very free, great information, weekly newsletter information into your email inbox, so you can learn about practical strategies and tips about how to increase your real estate wealth through investing in real estate cash flow properties. Thank you so much. This is Siwin Yi from Real Estate Network. Have a nice day. I'll see you on the next video. Bye-bye.